Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
All right. Welcome, guys. I want to welcome Spencer Hilligoss to our podcast today. Spencer, thanks so much for coming on with us. We know that you've got a lot of experience in investing in private placements, and just interested to hear your story. Do you want to start off by just telling us a little bit more about yourself and kind of what brought you to this point in here?
Yeah, and it's honored to be here, guys. I'm glad we could figure this out. So I lead Madison Investing, just a private investing club that I invest in and run, but it wasn't always that way. I sit here in Alameda, California. It's like a little island community tucked between Oakland and San Francisco Bay Area. Got two boys, young kids, 11 and 8, and I founded this business along with my wife and co-founder Jennifer. And so that's a whole kind of separate podcast on starting a business with your spouse. We love it, not for everybody. So I was in tech companies and have been in tech now for coming up on 15 years. And so a lot of these have been like fintech, finance tech companies like Intuit, Xero, Gusto, Kiavi, Stripe. Before that, I grew up in a real estate household. My dad was a broker, so he was a real estate residential broker for 30 years. He was having me do open houses and clean out fridges for properties he was trying to sell, and stuff that I thought at the time was so lame and so boring and not cool to tell anyone. And that's why I went into tech. And so I in hindsight, I don't know about you guys, but the universe kind of pulls you back into the stuff that your parents led you to sometimes. And apparently I had to get over that and get more comfortable with it before I could come back around and realize, oh, there's a good reason to be involved in real estate somehow. So
we just embraced it. Our dad was in real estate and we went right out of college, just right into investing.
Yeah. Hey, good on you. It served you well. Right. And so, for me, besides buying our home, we got very lucky. We found an up and coming market where we bought our first home in 2013 before it got really hot. Built some equity that also allowed us, amongst our own savings in the corporate world, to start buying some rental properties. And in hindsight, I don't know about you guys, but like entrepreneurship and investing is clear as mud. Like when you're going through it sometimes, like I don't have some crystal ball. I don't have all the answers. I just know like the figurative machete we have to pull out sometimes to find clarity.
Even just choosing the right machete for that task, right?
For the job. Yeah, man. And so I look at like 2016-ish is when we started to invest in rental properties. And we just wanted to go and find the off-ramp from this grind of the tech culture. I was waiting for the Silicon Valley lottery to somehow pay out the next Google IPO, Uber IPO money from one of the 5 companies I've been at. Thankfully, one of them hit, but I think it doesn't usually work out that way, and so we were just grinding and, raising a family with young kids and trying to find a way to get some relief as we were getting promoted and fewer hours available to be a present parent. And so we bought a rental. The first one we got, $430,000 purchase price in the Bay Area for $200 a month in cash flow. That's not exactly life-changing, but it's appreciated since then. And, you ask anyone, I know, AJ, you said you've lived in the Bay Area before, but I was happy to break even. So, you buy a rental in the Bay Area and you're like, you're just hoping to pay off the mortgage and the insurance and all that. But we eventually found our ways into buying long distance and, rental properties. And that kind of led us to investing in private deals as well. So long story short, it's been a wild ride and I'm very grateful for it now because it still is like a fundamental pillar of our wealth building strategy as a family.
Nice.
So Spencer, when you said that entrepreneurship and investing, I was thinking you were going another direction, and that those two hand in hand together are just phenomenal tools. Like building up a business that's creating income and then investing and receiving huge tax benefits from real estate, as opposed to it's just like so murky and so difficult I mean, the decision making and the strategy and the execution part of it is always so difficult, but the payoff aspect of it as well is, for somebody who can wade their way through all of the murkiness and the tough decisions and just making the decision to continue on, there is big payoff. And so I think
Absolutely.
that's
Absolutely. Well, and to that end, I mean, it has to be mentioned. For example, like last 2 summers, Jennifer and I did something we wanted to do with our kids for our whole lives. We wanted to break the mold a bit. We went and lived abroad for 6 weeks in different countries with our kids. Last year was in Croatia, Montenegro, which admittedly I had to look up on a map. The year before that was Portugal. And so living in these different places was only possible, to your point, because of what investing in entrepreneurship has enabled, right? And they didn't do that this summer in particular, but like those types of journeys have been made possible because of entrepreneurship and investing. And I appreciate you kind of honing in on that, though. What I want to get across with it is that, man, I read 400 books when I got into this. I mean, 400 podcasts rather, and 18 or 19 books in my first year when I got into this space, like way over the top on education, way more than anyone needs to do.
That's a good amount.
Yeah. but I think there are paths forward, and a key part of that is just connecting with other people in the space, such as yourselves, and going to meetups and listening to people who have had these experiences. Because I wouldn't be sitting here unless I was able to learn from those who have come before me, right? And so it's a path worth walking, to your point. Absolutely.
Well, and thanks for kind of giving us the little bit of the past, but I mean, why don't you tell us a little bit about what you're doing now?
Yeah, gosh, we're at the very beginning of 2026. What a different year than it was. If you look back to maybe 2021, right? Like really hot market at that time. Flash forward, you've gone through a few years of high interest rates. You've got some interesting volatility going on. And right now, we're looking at opportunities to invest still. The asset classes I've historically liked have been multifamily, have been, sometimes some self-storage, mobile home parks, medical office. So we're still investing and looking at deals. I think right now, we still look at the same 5-part vetting framework that we put together, that Jennifer and I put together when we're vetting a new sponsor and taking a look at a new deal. Same one we did then, but I'd say our pencils are thoroughly sharpened relative to what we first got into this, because it's no way to sugarcoat it. It's been a challenging couple of years, right? We've had some deals that went really well. We've had some deals that went very poorly. And that's paying tuition in painful ways sometimes. But I say all that like, hey, we're still here and we're still doing it because it is so worth it. And so the 5-part vetting framework is simple. It's like, look at the team, track record, their approach, communication, and their values. And it sounds nice and tied with a bow, but there's a very nerdy 70 to 75 row spreadsheet with questions beneath this thing. And so we're not going to go into all that, but you got to know who you're investing with. And you really got to take the time to get to know that they've done it before in some way, shape, or form. And they've faced headwinds, man. You don't want to necessarily park $100,000 or $50,000 or more with someone who is facing the first challenges in the market ever with your money. So there's so many different ways to kind of, vet and take a look at their performance historically. But yeah, happy to nerd out on that in whatever way might be helpful.
Yeah, well, I mean, I guess I'm just going to kind of ad lib this here. You don't know us very well. I mean, do you want to kind of take us through? I mean, I'm not saying the 70 questions per thing or anything, but maybe a couple of the questions in each of the framework.
Yeah, for sure. I mean, there's a couple that relative weighting you have to put a bit heavier. The phrase track record. We got to start with that one. What does track record really mean? And I take a look at some of the deals I invested in past years. You had a great looking IRR, the average IRR, internal rate of return for some of these deals. Pull up the hood and you're like, well, this sponsor had some amazing exits in 2021 2020, maybe first half 2022. And good on them. They caught the timing and they did their job. They operated well. Well, what happens though if you take away those really strong positive tailwinds that were happening in the economy at that time? And for interest rates, we were in the ZIRP period, right? The zero interest rate policy period. So when money's not free anymore and you're actually going out and seeing some challenges like higher insurance, higher taxes, property taxes, just supply, oversupply in the market. When I see track record now, I want to see that coupled with approach. And what that means very specifically is like, okay, this team has done it before. Have they done it in the same asset class? And have they done it perhaps even in that same market? And how well do they know that market? And I think about, I'm a big, obvious like guitar nerd, I'm like music nerd. If I were to pull out the comparison point, it's like if someone has been able to operate an asset, buy it, operate it, improve it, whatever that business plan might be, and sell it at a profit, they should be able to articulate that in exhaustive detail and show that on paper and somehow. Same thing if I'm learning a guitar solo or trying to, hacking through it. I'm not that good. I should be able to articulate, here's the steps that I took. Here's how many hours it took. Here's the lessons I followed. Here's all the different things that I practiced, the different chords and modes and all that stuff. And so nerdy music aside, that's got to be the first one. It's like, got to pull up the hood more. Track records look great. How do they achieve that track record is arguably the most important thing. So that's probably the first one to call out.
So do you do that just by like talking with the GP? I mean, I guess like functionally, like how do you go about that? Because I mean, presumably they're putting their best foot forward. The track record is usually a marketing piece.
Sure.
Right. So like, how do you get under that hood?
Look for the reconciling what is stated up front for the pro forma on just the financials. A lot of it comes down to looking at sources and uses. Okay, like what is the financials that were said that were going to be deployed? So perhaps the sponsor raised capital to go buy this asset, and they had a business plan. They're going to take the funds, allocate them, and deploy them to achieve that business plan. If they did that, how did it go? And you can, in practical terms, you can actually ask for just, well, let's look at at least a reasonable sampling of all the different investor updates and the financial updates that went out throughout the whole life of that plan. You don't have to look at all. If they're sending monthly, that's a heck of a lot of them, right? I'm not going to ask for a 5-year, 60 different emails, but I will ask for a pretty good chunk of them. Quarterly, a little easier. But you just want to see like, what were the facts that were being communicated? Ideally in the financials and the operational performance. You can see that with the T12, the rent roll. You could see that with the operational performance. You could see anything that was like unexpected capex that had to go out, and then how did it sell at the end? Like, and was the exit strategy that was performed, like when they sold that thing, was that the original plan? Was that to the buyer profile that they were even going for? Just all those different nooks and crannies can be evaluated in hindsight much more easily because you can just pull the information. And if they don't want to provide it, that's a red flag.
Right.
That'd be the first one. Yeah, I think a second one would be, if you look at, there's behavioral interviewing, and like one of the things that I would pull on from the corporate world, this is not rocket science, and you guys will probably, be well familiar with this, but like, if you're asking someone, hey, tell me about a time when, and I've done this with like interviewing for leadership roles in the corporate world and applied it to real estate plenty of times. But like, if I want to ask someone, hey, tell me about a time when a deal didn't go well. Like, what happened? Did something go awry? Was there like an unexpected expense that popped up? Was there damage to the building? Was there a new regulation that was passed? And if the sponsor is basically saying like, nothing happened, like we've never dealt with that challenge, or we've never had a serious headwind, that's one of the biggest red flags possible in my mind. You've basically got a scenario where someone is saying, oh, this is like we're perfect. I'm like,
because everyone is, right? Everyone's perfect.
It's like this, that doesn't exist, right? And we were talking about this a bit offline ahead of time, but like, we've all invested in deals that have gone far from perfect. And even on the good ones, like the first deal we ever invested in personally was a multifamily deal in Alabama. And it ended up being a great outcome. 2.5 years later, right? It was like a 2.3x equity multiple.
Yeah, I guess maybe circle back, like what time of the market cycle was that? Like kind of what years? I mean, because
It was like
the
2018.
last 3 years are significantly different than 10 years ago.
Yeah, of course. Right. So yeah, I appreciate you asking that, AJ. So like I have zero expectations for current investments that I'm making right now to go full cycle in 2.5 years with a 2.3x equity multiple. Maybe they're out there. Some of them, really, really good deals can be found. But this first deal we invested in around 2018, like that, it was a tree falling on one of the buildings. So it was a 2 property portfolio in the first quarter of ownership, which paused all cash flow. And we're like, well, we made a huge mistake. And then lo and behold, the sponsor handled it really well. Like they not only fixed it, addressed it, was very transparent about it, pulled all the levers they had to. And then ultimately we got our money back and more than twice as much at the end of it, So like that was some helpful timing in addition to that, of course.
What gave you the feeling that the sponsor handled it well?
The speed with transparency and their plan. I think something bad happening, that's just part of life and business. Something bad happening and then having it communicated with wild transparency done quickly, that's great. Everyone's an adult here. We just want to be communicated to transparently. And I think that was the big first step, AJ. Second one being, here's what we're going to do about it. Kind of the same principle. Like when I remember being in like my first or second management job in the corporate world and like leading people, and I felt way in over my skis because I was. And my boss was like, don't ever come to me with a problem without a plan.
We try to tell that to our employees too. It's like, you don't get to dump a problem on us. You need to have 2 or 3 solutions when you come to us with this problem.
Right. It sounds fundamental, but it actually is super common in a lot of the deals some of the deals rather. You invest in it and you're like, okay, got it. So there's this problem of an act of God, or maybe a fire happened, or oversupply, or whatever, macro, micro, across the board, right? And that's stuff happens, man. But how we choose the path forward, that's really what it's all about.
So you touched on communication and speed of communication. I mean, and you also mentioned monthly updates and quarterly updates. I mean, do you have like an expectation of what is good communication versus, what's not good?
Yeah. Gosh, I appreciate you asking that one because it's evolved so much. I used to put a premium on, I think a lot of folks, from what I gather, I've talked to hundreds of LPs over the years now. And I used to put a premium on monthly updates and monthly distributions. I don't care about monthly distributions and updates. I really don't. What I care about is good ones quarterly. And good ones quarterly with transparent, professionally packaged financials. Full stop. That's it. Like a business update with financials. And that's really the gold standard for me now. If a sponsor can clearly articulate without having like a 5-page novel, you don't need to have a ton of verbiage. What you do need is the facts. And the facts are usually told primarily through the financial lens, but also kind of like a strategic level update. Like, here's the big points that need to be stated. And then that's really it, right? Because in the end, there's 1 or 2 sponsors and bless their hearts, I've gotten to know them over the years. They will write a 5-page novel without just saying, I'm sorry, your distributions are paused. They will not be resuming. We might never turn them back on. We're going to sell the asset eventually, and maybe you'll get your pref caught up. That that's a hard message. But in that one example, I'm using an extreme one. I would much rather have the sponsor tell me that, as opposed to saying, hey, we're doing all this fluffy stuff. Hey, I do think on the values front, one of our 5-part vetting framework is values. And sometimes that comes across as really squishy, right? And I think it's not squishy at all to me, because what I mean by that is, at the same time, I know we're all capitalists. We're investing for profit. However, it does still matter to me that, like, if we're investing in something that builds wealth so effectively as all these wonderful private investments that we make, I still expect like the people living in the buildings to be taken care of and provided a good living community. And so, I also want to make it very clear that like, yeah, I've asked a sponsor before, like, what was your philosophy on tenant experience? I don't need someone to have some perfectly worded whatever plaque that they put on a wall, but I hope that they would at least think about it and at least have put something on paper to talk about it. And this one sponsor who made it through every other hurdle of our vetting process kept dodging the question. And ultimately, we weren't able to work with them and we weren't able to invest with them. But I just bring that up to kind of couple it also with like the tougher talk of like, man, I want to see those financials because both things are true. It's like, just state the facts. If stuff's going well, state the facts. If stuff's not going well, and at least prioritize the people that are going to be living in the asset. It's a little different with self-storage because there's no one living in the units, hopefully, right? But
Let's hope.
Yeah, let's hope. But like in multifamily, yeah, there's real human beings living there, and it matters to us.
So you touched on, verbiage and then financials. When you're evaluating, quarterly update or I guess when you're evaluating, like previous deals at a sponsor where they're giving you the quarterly update with the financials, how are you reconciling what they're saying in their words and then what is on, and then I guess what type of financial reports do you really want?
Yeah, nothing too innovative, frankly. Uh, just the basics, and the basics. And you guys will keep me honest on this one too, because I'd be curious to hear yours as well. For me, it's just reconciling the initial pro forma, the Excel spreadsheets that actually state, hey, here's what the plan is by year, by quarter. I mean, if they did it by monthly, cool, but sometimes stuff changes, as you guys know, right? So if you don't want to get too granular where it's unproductive, but I would say some initial business plan pulled out, extrapolated over the course of 5 years, if it's a 5-year hold, 10-year, because you want to have some contingency plans, hopefully. And then take a look at reconciling that with whatever financials have been, made available along the way. So just P&L, like profit and loss statements, income statements, all that good stuff to be able to say, is that NOI on track for where we expected it to be by the end of year X? Year 2, year 3, year 4, and why? And it's just those two things at a high level. Like, okay, are the dollars and cents making sense? And if so, how come they're going well? It's okay if it's not perfect. There's never been a perfect forecast in human history, right? Nothing ever hits exactly 100%. It's going to be higher, or low, or somewhere in between. But as long as it tracks on the story and you can reconcile that with the numbers. But does that answer your question though?
Yeah, I think so. You're just taking a basis of the pro forma and comparing it against, the whatever T12 that they have, or if it's a quarterly report, what they made in the quarter. Like, I guess, certainly there's variances that are along the way. Like, what are you looking at that for your current investments, or is this just like a project that you do when you're evaluating a new sponsor?
Yeah, I mean, really, we're spending a lot of our time more so on new potential deals, right? Of course, it really comes down to like once you establish that trust with a sponsor you're happy with, like the deal's going well, and you've ideally exited other projects with them, right? I mean, we've already exited a couple dozen across the different sponsors, and ideally, we're going to be looking at those less mid-flight once we're getting into the second or third deal with that same sponsor, and it's already been purchased and they're working on the business plan. So yeah, we're spending most of the time, AJ, out on looking at the new deal flow and just trying to find stuff that's going to be really good.
I mean, there's not really much you can do after you send the money and sign the PPM. Like,
that's exactly right.
It's not necessarily a sunk cost, but
if you're contemplating, investing more money on another project, like having that information probably would be, something to look at. Like, are they, within a couple percent of their NOI, or are they, way above or way below? And then, on top of that, is it a result of market conditions, or is it a result of like actual operations?
Yeah, I mean, I think you're hitting on a really great point. I was just having a conversation with another LP I've gotten to know over the last couple of years this morning about this, which is like he just invested with a sponsor that both he and I have been looking at for a while. And the sponsor reached back out and immediately said, like, we're talking like 2 months after he had made this first investment, they reached back out and said, "Hey, we got a new deal. You want to take a look?" And he was just sharing with me, he's like, "Man, I'm not ready for that yet. Like, they just closed on the property. Like we don't even know how the last one went, and they're coming back and saying, 'Come and do the next one.'" And admittedly, I've made that mistake. I've made that mistake where I was so excited about the deal with a first deal with a new sponsor years ago, and I was like, "Hey, let's go into the next one with them." And then I look at what has happened with that sponsor, and I'm like, should have waited. Should have waited. Because time tells you a lot. But
Yeah, and I mean, even if they have a substantial track record too, right? Like it's getting, up on their cadence of, how they do things. And, I mean, if they've been in the business, 20, 30 years, like there's a few players out there, but I know that they've had some real struggles in the last 3 years as well. So
for sure, the established ones and the emerging ones, right?
yeah.
100%.
I kind of had a question. Like your 5-part framework is very much geared towards the sponsor. I mean, how much weight do you put on the deal compared to the sponsor? I mean, I think we've all heard the saying of like a bad sponsor can turn a good deal bad, and a good sponsor can take a bad deal and do okay. But certainly I imagine it's definitely weighted on the actual sponsor. But like, well, I guess from your personal opinion, like, how do you look at markets?
Yeah. I mean, you took the words out of my mouth in the best way on that one, AJ. I think truly, like, thankfully, the filtering gets a lot easier just because you don't have to go any further than the sponsor level most times. So you start there. So you're weighting over 90% probably, if I had to put something quantitative into a pretty qualitative question. But like out of sponsor, market, and deal, over 90% of that goes on the sponsor.
Yeah.
Then you get down to the deal. I'm fairly open-minded on markets. Just to briefly comment on this, I feel like the places I haven't dove into, so it's more like I guess I'd be open to them, but I haven't done it yet myself, are primary markets. Like I haven't invested in something that's in downtown San Francisco or downtown New York or Chicago. I don't know about you guys, but like I'm open to those. I just haven't necessarily gone deep on them. So we've largely looked at secondary and tertiary markets.
Yeah, I mean, I think some of those are few and far between too.
Right.
The product that we're in Portland, Oregon, and we're doing deals here in Portland, Oregon, and a lot of the product downtown is 100 years old, and you're not doing a full renovation on it. It's more of a yield play, and construction costs are way up. So we don't see too many of those deals.
Or you're doing new development.
Yeah, and new development, super risky comparatively to the space that we're in, which I think is kind of like a misnomer too amongst LPs. They see that bump in IRR, but it's hard to measure the risk associated with that.
That's right. Oh man, you hit on one of the most common topics that I feel like I'm obligated to get into with new LPs all the time. I don't know about you guys, but like when I'm asked like, "Hey, what do you think about this deal?" I'll get into that with every LP that I talk to. But the first question I come back with is, "What's the goal for the money, man? Like, what's the goal for the money?"
Number one goal is preserve capital.
Yeah, absolutely, right. And so, assuming that we're all in here for the primary goal of let's preserve the capital, then are you trying to grow it, or are you trying to just generate a cash flow from it? And 9 times out of 10, I don't know about you guys, but the same sentiment is usually shared at this point, which is, I don't know, a little bit of both. And it's like, cool. If that's the case, by when? So just kind of pulling back on the ever deepening why questions. Like, okay, and I need this reminder too. like my lizard brain kicks on hard when I'm looking at a beautiful looking investment summary still. And I say, wow, that 25 to 30% IRR seems really sexy. So it's like
Well, and the new building looks sexy too, doesn't it?
absolutely. Yes. It's like it's all shiny and new. It's not 100 years old. It's not like
Yeah.
most of the properties that we all look at in like the Bay Area down the street. But I think in terms of just goal setting, it's very grounding to just kind of say, okay, we all want to preserve the capital, but do we want this money to actually grow? And do you even need the income? Is because everyone kind of is conditioned to say, I want the cash flow. And I ask an Apple engineer who makes $400,000 a year, been in that job for 8 to 10 years, has 2 kids at home, a generation living with them and a floor above them. And they're trying to not leave their job right away. They're not trying to quit the rat race. They just want to continue growing their wealth and provide a cushion for the years to come. They don't need cash flow. It doesn't change anything in their lives. What they want is their capital to be there at the end. And they want there to be a nice equity multiple on the other side and to be able to tell their friends they've invested in a big real estate project. And I'm not being facetious. Like that's 9 times out of 10, that is really the check boxes that folks are often looking for, So I digress, but I just wanted to at least share that like that is super duper grounding for myself still, just to be like, hey, why am I evaluating this? Is this going to be a cash flow play? Am I trying to hit a cash flow number still? Or is that something that we're not pegging for this year to be a goal?
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Hey, let me ask you, what if tax season was actually exciting? I know, it sounds crazy, but not when you've got the right playbook. At mymoneyworksforme.com, we put together the Pro Tax Strategies playbook that real estate professionals use that you may not know about. You'll learn how to crush taxes with depreciation and rep status, how to stack smart write-offs from the Augusta rule to vehicles, and the ultimate wealth hack, 1031 exchanges and vacation rentals. It's free, it's powerful, and it's waiting for you at mymoneyworksforme.com, because your money should work as hard as you do.
Nice.
And so I guess when you're talking about value add versus new construction, how, like from our perspective, new construction is extremely risky just because of permitting, zoning, construction delays, et cetera.
Performance,
and
lack of income.
And I guess I'm interested to hear your take on it. Yeah. What do you think about new construction?
Almost identical perspective. I have invested in terms of single asset deals that I'm invested in. It's always been, there's been a building there. It has an address and there's a building. I think that I have invested pretty significantly into some funds that might be blended with a percentage of new build. I can get comfortable with that, but it's not the majority percentage. It's one example or 2 examples I'll share would be in self-storage. Like I've invested in some funds where it's like, okay, cool. Most of these are established in markets that are not oversaturated, not expected to be oversaturated because of overbuilding. And there's like 1 or 2 new facilities that are going to get built. Cool. Out of like 15 plus to 20, I can get down with that. There's a good risk balance there. if you're looking at like multifamily, kind of same story, which is like if they want to build some new stuff in a blended fund, most of the other buildings already need to be there, and operating cash flow positive, all those basic things. So I'm right there with you on that. I'm not. Maybe that's just me. I know some folks like to shoot for the moon, and they like to go for those 3x equity multiples and see their money come back if it goes well. Knock on wood, within a 3 to 5 year period. Awesome. That's not me.
You kind of touched on the fund aspect and blended funds and single assets. How does that come into play when evaluating the sponsor? I'm assuming that's, evaluating the deal, and it sounds like you've invested in both. Do you have a preference of either one, or do you find one to be better than the other? And like, from your opinion, like, what are the advantages?
Yeah, gosh. I don't know about you guys. My philosophy on this has evolved a lot in the past 5 years, and largely because of some of the wins and some of the tougher learnings along the way, depending on single asset versus blended fund. I think that my appetite for getting into a blind fund, when the sponsor says, here's our big plan, we don't have any assets necessarily closed, but here's what we're going to go buy in the next 5 years. I used to be more open to that until I've kind of seen some sponsors do that really well. Some sponsors don't. We'll just leave it at that. The confidence to say, okay, I believe in this sponsor because I've exited deals with them has been the only time that I've been confident necessarily diving into a multifamily fund like that, and seen the positive results already from like, okay, wow, they exited that deal. It went that well. They ran their plan. I think they can pull this off. Based upon what I've seen. Otherwise, I would say that kind of shift gears for like who is a fit for funds and who thinks that they're a fit from an LP lens. This is a bit counterintuitive. I don't think it's contrarian to say in 2026, but but since you asked, AJ, like I would say that oftentimes folks who want cash flow from their deals in multifamily syndications and funds, oftentimes they're the first ones to say they only want to invest in single asset deals. And I think that that's an interesting perspective because single asset deals, they could be the home run. Oh my God, it's wonderful when that happens, right? You invest in an amazing deal, it goes well, sponsor crushes it, cash flows along the way, and exits really well. When reality hits, sometimes it's nice if you want smoother cash flow to have 5 to 7 to 10 different assets in a single fund, because if one of them doesn't go well, the rest can still provide positive cash flow. So for the investors who like to do larger investment amounts and they're investing with a sponsor and it's actually like a really good track record, they got a great investment thesis, they've got the right management structure, operations look good, sometimes a fund can be great. It really just depends on what they're trying to solve for, and I think that didn't used to be my perspective. I would say that I used to be much more keen to say single asset deals or bust. And so many very, very new LPs will only ever look at single asset deals because their head kind of explodes from the concept of thinking about a 5 to 7 to 10 asset fund of any type, because it's confusing. But yeah, I still believe that there's a time and place for a good blended fund with a very experienced operator who's capable of managing a fund.
Yeah, we started syndicating probably about 5 years ago, 6 years ago now, and I've only done single assets. But we've talked about, the potential of doing a fund. And maybe I'm just kind of curious from your experience and talking with a significant amount of sponsors, which sounds like you have. Like, do you have a sense of like the progression a sponsor takes to, get to the point of, having a fund with, 5 to 10 assets in it?
Yeah, at least the ones that I've seen that went well, they tend to have, at least, I'm using this very broad strokes, but like, half a dozen to a dozen exits already before they kind of go for that. I think that is the right general trajectory. Who am I to say the right one? There's so many different sizes of assets. There's so many different flavors of success, right? Like, winning can look so different depending on the size of asset. There's a really great team that I've seen that is buying, around 50 door assets, right? Like great size. It doesn't matter if another sponsor who focuses on 200 units to 300 units and up will go and launch a fund because they think that they can do that, add 5 to 7 assets into it, and they've already got a great track record to go do that. Totally apples and oranges, right? I look at that like you have to just take it in the context of the size of asset and the markets that they're going to go execute in, because someone's buying a smaller property and they want to go all of a sudden go buy a 500 unit in Dallas, Texas, or DFW. Like you got to stick with what you're good at, and hopefully the fund that they're trying to launch or someone is trying to launch is still focused in their same core buy box and criteria and business plan that they've already done. In which case, then my confidence level is going to go up. It's when people try to jump lanes, that's when my back gets up. It's like, oh, so you guys are trying to buy something totally different than you've ever bought, and that's what your new fund is about.
It makes you wonder why.
Yeah. Yep. I mean, similar to without going too far into it, some of the funky stuff you see out there in the past 3 years, when a sponsor puts together a pref equity fund or a preferred equity fund, and they suddenly got into that and they've never done it before. They've never done any debt or private credit or private debt stuff. And suddenly they're really good at that. Those things raise my eyebrows.
I mean, I guess my take on that is that they have significant overhead and they need to keep transacting to continue the business that they built.
I would agree with that assessment.
Yeah, it's more of a necessity to exist, which means you also strip potential returns out of, future investments, I guess. I don't know. I'm going to not change the subject, but kind of still along the lines of like evaluating a sponsor. Like, what sort of stock do you place in a sponsor that's vertically integrated?
Gosh.
And is it a plus? Is it a minus?
Well, how do you evaluate it?
Yeah.
I think this is a very fun topic to talk about, honestly, because now having seen what happens I've seen both work. That's the bottom line. I've seen both work. Ideal case, they're vertically integrated and they know what that means. The challenge happens is when they think they need to be, they go and do it to then find out they don't want to be. And then you're screwed. And I've lived through that. That's not fun. It's very expensive for everybody involved. So without being preachy, I'll just say, I think third party is a fine option for a sponsor that knows like who they want to work with, to have a third party management firm. That's great. I've seen that work really well. I've invested in deals that have gone full cycle, and that was the playbook. And they solved for that in their pro forma, and they ran that business plan, man. They're very self-aware about it. More power to them. It's more cost effective and more it's in general more effective if the sponsor is vertically integrated and they know how to do that. And so it's about a tool. I look at it like from a really high level, and everything else in business, it's a lever you can pull. It's a tool in your tool belt. If you pick the wrong tool or you don't know how to use it, you're going to be in hot water. And so ultimately just choose wisely.
I'm interested in your thoughts on third-party management and how it can be successful. I mean, I know that there are many, many, many cases where it's successful, and that third party just does a fantastic job. And so I'm interested, like, how do you know when that's going to happen? And then how do you know when your spidey senses are kind of...
Spencer, I'm going to give my take on this before you give us the real answer. But my sense is that you probably wouldn't want to invest with a sponsor when it's their first time with that property manager. You want to see a historical relationship with them.
You did take it out of my mouth. No, you're exactly right. Right. And I mean, to expand on it though, what are the benefits? Because I think your question is a great one about when it works, like, why does it work well? There are certain competencies that come along with doing this well. And these are things that folks can very much build in-house, and they do build in-house. so much of it comes down, it sounds simple, guys, but like, I don't know if you've experienced this, professionally packaged financials. Like, this is like, can that company translate what is happening with, fixing a broken door on the second floor of building 1 and explaining that was fixed on this day, and somehow translate all of that into a reporting infrastructure, translate the expenses put toward repairing that door, and then multiply that times 1,000 other things that just happened on that throughout that month. Put that into a professionally packaged infrastructure for reporting, because in the end, where it falls apart utterly, is when you don't have a dashboard. You're flying blind, man. And I feel like so often in business and in real estate and in life, we just have to know, are things in the green and the yellow and the red. And definitely have seen what happens when all of a sudden, you're multiple different quarter, like 3 to 4 quarters in, and suddenly sponsor says, oh, we just found out blah. And that blah is a 5-digit repair number on a relatively small building. And you're like, yeah, that water heater needed to get fixed like 6 months ago. And why was that not identified earlier? Well, it's because their operations are not tight. And so I'm using a really nerdy, very specific example.
Yeah.
There's so many other ways that we could skin that cat, but you gotta know what's on the dashboard, like what's on the radar. Are things going well, not going well? Or are they going really poorly? Because that's when you have to intervene quickly. And if you can't act quickly because you don't know what's happening, then you're in hot water. I don't know if that answers your question.
Yeah. I mean, that's one area where like being vertically integrated is nice, because
Completely agree.
When that work order comes in, it goes straight to the asset manager as well as the property management company. And then, it's pretty easily triaged.
Totally agree. Yeah. I mean, generally, best case scenario, dialed in, vertically integrated. that would be ideal.
Nice. Well, in case you were wondering, we are vertically integrated.
That is awesome.
Yeah, we have the construction company that supports the property management company, the management company, and then syndication company. So,
which is really hard to stand up. So kudos to you guys.
Spencer, I'm interested in your family investing. I mean, you run Madison with your wife as well. Your dad, I'm assuming he taught you a few things, and you'd consider him a mentor.
Oh man, yeah. In terms of the, these are all the things that you don't really realize you learn until later, right? Because most of us learn from role modeling, and then eventually emulate those things in how we talk and how we think how we question life, all those things. So I used to, as an example, give my dad such a hard time. Like, Dad, why the hell do you wake up at 4 a.m.? And I was always so confused why he did that. And there I was, like, in my W-2 career, needing to find time to go and learn this nerdy stuff that is multifamily, large apartment real estate. And no one else wants to talk about it at my day job. So I have to spend 2 hours waking up at 4 a.m. to go study like a nerd in the dark from 4 to 6 a.m. to go do the job before the job over the course of like 2.5 years, And I'm like, well, where did I get that? That was from Dad.
And well, how did you even know it was possible?
Right. I mean, that's, and I appreciate you asking the question. I look at that, and one other thing to call out though is, there's a resilience and an entrepreneurship on resilience, I think, that came along with an experience that we kind of refer to as like a dark decade in our family. And I won't go too grim on this, but this is what happened. When I was like an early teen, mid-teen, my dad's business was like absolutely flying. This is like in the 90s. And my younger brother, who's a teenager at the time, he got terminal cancer. He passed away many years ago. But my dad's business, suffered because of obvious reasons, right? And that was the family's sole income, right? I mean, the brokerage business means you're working, or you're working and you're getting an income, or you're not, and there's no income. And seeing his ability to persist through that it really just stays with you. Yeah, and I think it also humbles you in terms of what, I mean, there's so many other learnings to unpack there we don't have time for, but I'll just say that, like, hey, what happens with a one income household and how do I avoid that? Like the learnings both in terms of action as well as things to not do. I'm so grateful for him, and for all those lessons that he imparts, both in his actions and role modeling, and also the tough lessons about what not to do structure wise. How do we add more income streams to our family? All those important things that lead me back to, hey, this whole investing thing is a really good idea.
Yeah, that is a great story that promotes, gaining that passive income. So when hard times do come, like there's a little bit of cushion too.
Absolutely.
Right? Yeah. Thanks for being vulnerable and sharing that.
Yeah.
This is probably a good segue. You had talked about some of your material learnings from the past 3 years, because as we all know in this market, it has not been the smoothest of sailings. So I think maybe a good time to jump into that.
Yeah. We talked about sharpening the pencil and how important it is, right? There's a few things that are kind of like the just moments, but they're probably for any folks that are, amongst your listeners and they're like new to the space. I look at these as pivotally important now, and I go much harder on them than I used to in hindsight. The first one being, okay, well, debt. You have to talk about the debt. Invested with amazing sponsors. I still believe in them now, but some of those deals, they were on floating rate debt. That floating rate debt, I sure wish some of those deals were on fixed rate debt. And so is there a time and place for a bridge loan? Is there a time and place for variable rate debt? Of course there is. Absolutely, there still is. But I'm much more keen to look at deals with fixed rate debt these days. And so I think that that's got to be one of the overarching big ones. We really hit on kind of the core of the other ones, though, I would say already, which is like the track record isn't enough. Like the track record at a high level isn't enough. Like you really have to peel back what's underneath the hood. Like how is that track record achieved and how are they going to apply that on the next deal that they see? And last but not least, man, I definitely wish I had stayed like purely within, at least in terms of private investing. I know I have a lot of friends and brethren in the tech space and they like their angel investing in tech companies. This isn't really about that, because that's its own category. You can get a multiple of 25, 30x plus 1 out of 100 deals. Awesome. More power to you. That's its own thing, man. There's other niche opportunities outside of real estate in private placements, and I've invested in a couple of them in the past few years, and I've lost a lot of money from that. And so I'm sticking with real estate. I'm sticking with real estate because it has an address. Unfortunately, there are some people who do, sus, as my kid would say, sus behavior, right? Sketchy behavior. And like, you don't want to encounter bad actors in this space. And just in terms of due diligence in real estate, there's some beautiful things about due diligence that you can peel back the hood and just see more concretely when you're doing that due diligence. So those are really be the key themes, guys, is like, number one, make sure that debt in the capital stack is solved and aligned with the right plan. Number two would be, gotta go and look underneath the hood for due diligence beyond the track record. And then number three is stick to what you know. Just stick to what you know. And what I know is a lot of this real estate stuff, like multifamily, that was the primary asset class we focused on. Self-storage, that's become secondary one we focus on. But when I strayed away from that, I got hurt. And I would like to lean into that.
Do you mind giving a couple examples of some of the shiny objects that you looked into or invested in?
Yeah, I mean, one of them was like crypto. Crypto in general, I don't condemn. Like I've owned Bitcoin and Ethereum and everything, but one was like a crypto mining thing. Ended up just in some fraud, So it'd be that, and just other niche business models, within the space. But I don't want to overshare.
Just out of curiosity, I keep seeing that there's a couple companies that I'm on their list for, and I'm just curious if you've looked at them or have any opinions on them. But one is like the oil gas sector.
Oh, the scrubbers, oil scrubbing.
And then the other one is land banking. So there's a company that will buy up tracts of land and then do the entitlement and then sell it to like Taylor Morrison or sell it to someone else. And they're usually pretty quick turnarounds, but And I haven't researched into the gas thing a lot, but what I do hear is that the tax benefits on them is just substantially higher than normal real estate. And I was just curious if, like, with those other, investments, was there a draw for you to them like that, or was it just the promise of a higher return, or like what kind of drew you to these other things?
Yeah. Oh, that's a great question, AJ. The characteristics are the same ones that you and I appreciate about real estate in the first place, right? I mean, I want cash flow, great return, and ideally some depreciation benefits. I mean, that's the big, triad.
Yeah.
For oil and gas, I have circled that for years. I've looked at multiple sponsors. I've talked to multiple sponsors. I've looked at multiple investment summaries, many, like I've seen. Okay, the big reasons why, as to your point, that people tend to be attracted and happy with their investments, at least on this front, is that wonderful looking K1, where they have like really good depreciation losses on it. More importantly, the reason I was circling it so long, and I haven't pulled the trigger on it yet, and I'll be happy to share why, but is that you can actually get active losses, at least as they say. And this is my moment to give I am not a CPA nor a tax professional. None of this is tax advisory, yada, yada.
Neither are we. So
yeah, none of us are tax professionals. But to go as a sponsor to have an offering of, there's so many different business plans within the oil and gas space, right? The different versions and flavors of business plans that they run with. But across them, you'll find regularly these structures that say, oh, an LP can be structured as a GP and therefore get active tax losses to offset their W-2 active tax burden. Well, to a medical professional making $800,000 a year, that sounds very attractive. So where I hesitate is that I have yet to talk to, and this is just me personally, this has nothing to do, I'm not condemning the space. I'm not condemning the sponsors that work in that space. Disclaimer provided. I just haven't personally talked to a CPA that condones that structure. So that's all that I know personally, which is why I haven't pulled the trigger on getting into one of them. So, but, I think that it's, hey, I don't want to comment. I'm not an expert on the oil industry. I'll just say that it got a lot more interesting in the last week. So, when the US decided to go into Venezuela. So, I don't know what that all means and ties into. So I'm probably not going to be diving into oil and gas anytime real soon.
Yeah. Uncertainty doesn't provide, high risk, or not high risk, but high,
low volatility.
Yeah.
Right.
Yeah. Going back to, I guess, evaluating sponsors, or essentially just lessons learned, I'm interested to hear in how you evaluate, you talked about debt, but how do you evaluate the capital stack when you are looking at a single asset deal?
I think one of the things that I put a premium on now is really getting a sense of like the who, not just the who, like who's involved, who's the lender, like understanding who is the lender, is there preferred equity in the capital stack, like a preferred equity lender in the capital stack, other layers, those are things that I put a very big focus on now, just because I've been in deals where there's preferred equity and you find out after the fact that there's like certain things that lender can do that puts like your capital in jeopardy. And you may not even realize that at first, right? And so that's got to be kind of the big headline call outs on how I think about the capital stack, is just making sure that, well, first and foremost, also that the amount of leverage is reasonable relative to that business plan. They're not taking on more debt than they can actually handle, that there's some cushion in there to be able to cover the debt obligations, the DSCR, the debt service coverage ratio, all that stuff. And that there's no mystery lenders that can pop out of the woodwork and suddenly say, you have to sell this asset, even though you're going to take a massive loss on it and wipe out everyone else's capital. Like that kind of stuff you can spot ahead of time, as long as you're just asking the right questions and like, understanding who the lenders are that are involved. So I'd say that's got to be some of the big ones.
Yeah, we learned that lesson the hard way last year, sadly.
Oh, I'm sorry to hear it. There's a lot of that going around.
It's about a year and a half ago, we were at a conference, and the theme of the conference was rescue debt. That it was people were raising rescue debt funds.
Yes.
I guess
I heard about this.
for deals that had been invested in, that were going to need to be rescued. And so, yeah.
Yeah. I mean, there's a lot of that going around. Unfortunately, I hate to say, but you're not alone on that one, but I'm sorry to hear about it.
Well, I think we should probably wrap this up. We've got four questions for you.
Spencer, you got time for 4 questions real quick?
Absolutely.
All right. I'll start us off with the first one. What's one piece of advice you would give to your 25-year-old self?
Treat every interaction as a relationship, not a transaction. We all tend to be very focused on ourselves in our 20s. And I was very much included in that. And, I think every person you work with in a company, or, you happen to partner with, or whatever, man, you just meet them because you're both parents of kids in the same class. Like, these are all human beings, and it's just, the world is way smaller than you tend to realize until you get there later on. And then you're like, wow, I'm really glad that I got to know that person because of this new opportunity or whatever else happens.
Wow. What was your first entrepreneurial endeavor?
Gosh, I don't know if it counts as playing in a band, but maybe it does, because if you make $1, they say you're a professional, right? But yeah, I played in a few punk rock and metal bands, and so that probably would be it. But I don't think playing dive bars up and down Capitola and Santa Cruz in California counts as necessarily a big entrepreneurial endeavor, but we made some money. So
that's where you get
experience.
Yeah, you get your experience, you get your little taste of the pie,
and you're like, this is the lifestyle I want. Yeah.
Yeah. Usually it's like, man, that was really hard for that couple $100.
Yeah, exactly.
Next question is, how has your formal and informal training shaped your journey?
In the corporate career, 2 of the most powerful mentors in my life talked me into going down a leadership path when I really had no interest in doing it. And this is in my 20s. I ended up going from a kid who didn't find business that interesting at all, frankly, part of that whole playing in a band and punk rock thing, to then like leading teams of like 200 people for Fortune 500 companies, and I was like, how did I get here? And I'm not qualified for this, but flash forward years and you're like, those lessons and principles are just instilled in you forever. And, that informs how I parent, how I'm a dad, and how much hopefully show up as a good husband, and lead Madison Investing today. And so I look at that like, you never really realize where it's going to take you when, the both formal and informal, like I've been through tons of leadership trainings in the W2 environment, and just the hardcore, hard-nosed, very direct feedback that you get from mentors. I tend to be pretty dense and slow to learn. And the best bosses have been the ones that get very, very, very candid with me. And I'm deeply grateful for those people.
Yeah. Wow. All right. Our final question. What was your biggest mistake and what did you learn?
God, this is a platitude, but I have to put it out there. Trust but verify. Trust but verify. And I think that means like, we talked so much about vetting today and like, doing your due diligence. And I'm inherently an optimist. I try to see the positive outcomes. And I think I have to hedge against that, because someone with the right intentions at the beginning, especially as we're talking about real estate deals, 5-year hold periods, 7-year hold periods, that's a long time, man. People change under pressure. So trust but verify means trust someone's intentions, when they say that they're going to go do it the best they can, but verify that they actually can deliver on it.
That is solid advice.
Easier said than done, but yeah.
Well, Spencer, it's been a pleasure chatting with you. Thank you for opening up your book on how to vet sponsors and your experience in investing. We appreciate it. If our listeners,
valuable. Thank you.
Yeah, if our listeners want to get a hold of you and pick your brain a little bit more, what's maybe the best channel to get a hold of you, and if there's anything else you want to plug?
Yeah, well, thank you to you guys. I appreciate just nerding out in the fun way on all these topics. So they can find us at MadisonInvesting.com. And yeah, they can reach out and we can soundboard some ideas about investing and all this other stuff.
Awesome. Well, thanks again for being on the show. And looking forward to chatting with you more.
Yeah, thank you guys. Really appreciate it.
Cheers, Spencer.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on Win, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.